I'm Meg Green with AM Best TV. AM Best recently analyzed the performance of its rated life annuity insurers since the October 2017 update to Best's credit rating methodology. Here to discuss this analysis are Rosemarie Mirabella and Tom Rosendale, both directors at AM Best. So, Tom, can we start with you? How fundamental is BCAR to the balance sheet assessment, and how do other factors weigh in?
Well, the BCAR is the starting point for the balance sheet assessment, so it points to a specific assessment category as a beginning point, but we have a number of qualitative and quantitative factors that we also take into account. And I think it's important to note that many companies actually end up with a different balance sheet assessment than the BCAR points to as a starting point. Those other qualitative and quantitative factors include things like the quality of capital. For instance, are there a lot of surplus notes in the capital structure? Are there captives utilized to take reserve credits, at the operating company? Other factors include liquidity, the sufficiency of liquidity, quality of assets, the appropriateness and the dependence on reinsurance. So there's a number of other factors that go into the assessment, and I would point out that as we looked at the numbers over the first year, the dominant category really in terms of balance sheet assessment was the very strong category. I think it was about 43% of companies who are in the very strong category. And the median BCAR score for those very strong companies actually pointed to the strongest category. So what that tells you from a mathematical perspective is that the majority of those companies actually had BCAR scores that pointed to a higher assessment. But through utilization of those other factors, we came to a lower balance sheet assessment. And it can go in either direction, but it's an important point that the BCAR isn't everything.
So Rosemarie, what are some of the other metrics that AM Best uses in the operating performance assessment?
The operating performance assessment, we look at a number of mostly quantitative metrics there. So we're looking across multiple accounting regimes, and we're looking for factors such as normalized earnings, what kind of premium growth the company's been experiencing, whether or not that premium growth is appropriate for its capital base. We're looking at its investment yields, the amount of financial leverage or the amount of leverage that's embedded in the returns, the volatility of results, if they're stable or if they're volatile. So we attempt to normalize it, try to look at it across multiple accounting bases, and get a fundamental handle on what the organic earnings growth is within the enterprise.
So what factors go into the business profile assessment?
Well, the business profile assessment is probably the one of the least quantitative in nature. So it takes into account a lot of categories that don't lend themselves to kind of numerical metrics like operating performance and balance sheet assessment do. But it takes into account factors like market position, the degree of competition, product and geographic distribution, the distribution channels that the companies utilize, the quality of management, pricing sophistication, product risk, and regulatory and market events, their exposure to those things. So, I think, when you look across the sum total of those categories, you can see it's difficult to move your business profile in a short period of time, because those are the kinds of things that when you think of a company with a mature book of business, it's a bit like navigating a cruise ship. It doesn't turn on a dime. And so it takes a while to migrate your business profile from one category to the next.
We did see that by and large, the business profile assessment was largely unchanged for the most part. Some very minor changes in categories, which is consistent with what Tom just said.
So what are the considerations when determining a company's level of enterprise risk management?
Enterprise risk management assessment, just like the business profile assessment, is not necessarily that quantitative in nature. It does incorporate some quantitative analysis. Here we're looking for what a company's risk tolerance is relative to their capabilities and their risk profile. We typically look at many different metrics. We start off with an overall assessment of the company's framework, its corporate governance structure, the degree to which risk management is embedded in the organization, the risk management functions that a company performs, the risk appetite statements that they perform, whether or not they do any kind of economic capital modeling or stress testing, which is where the quantitative metrics come in. It's very important to a company's overall assessment because it's AM Best's belief that ultimately good risk management practices will ultimately drive balance sheet strength and operating performance over time. But it too is one of those categories where you by and large will not see tremendous amount of movement in any one year. And when we look at the benchmarking, those results are generally consistent with the prior year.
Mm-hmm. Yeah, I would just comment that over the long term, while all that's true, over the long term, we do expect that companies, will have to continue to further develop their risk management frameworks and practices because the bar is going to be raised over the long term, and our expectation is that companies continue to develop that capability in order just to maintain the current assessment they have.
So we view it as a process, right, not a destination. And to Tom's point, the world is constantly changing, and we do expect companies to continue to make significant improvements and be able to demonstrate that not only do they have a framework in place, but that it's effective and can be tested over time.
Thank you both for speaking with us today.
Thank you.
To view a full copy of the report, visit ambest.com. For AM Best TV, I'm Meg Green.